Thanks, Julian. Good afternoon, everyone. Great to see so many familiar faces, and good morning to our international guests watching online. I'm never sure how I get myself into this, having to present the entire baseline to you in 45 minutes, but we'll give it our best shot. The good news is Julian's covered most of the international dynamics, so that helps. We don't have to go there. The other good news is that being the 20th baseline, we've got practically our entire team here, so I am going to present to you everything that I can. And then we're going to take a coffee break, and I'm sure they'll be happy to answer all the difficult questions for you through that break. So let's go. Let's have a look. I thought I'd start just with a few realities. I think doing this baseline, we've been doing it for some years now, and it feels like it gets more and more uncertain, but I think this year's been particularly difficult, just given the point that we're starting from and everything that's going on in the world. So a few realities that are out there that will influence us and that drive the baseline that you see. First is, of course, economic pressure with ample downside risk that holds both internationally and in South Africa. So, of course, the world's trying to get through to deal with inflation. A lot of actions being taken that's a bit constraining to growth. China's recovery is slow, but then also in South Africa, we've got a number of structural challenges. So it's been this ongoing effort to accelerate growth. In quite a difficult environment. And of course, what also influences that is the ongoing war in Ukraine. So Julian has touched on that. It influences both the macroeconomic picture, it influences world prices, and of course, there was an initial big response which sort of settled down. But then we've had the Black Sea Grain Initiative not renewed, and there's this sort of new uncertainty and unease in the market related to that. The other, Julian's just described beautifully in this new trade environment where international trade finds itself. So, post-pandemic and with the war and everything going on, we're seeing a lot more countries looking inward. And instead of saying free trade, open up trade, make trade easier, it's actually becoming progressively more and more difficult. And of course, for South Africa, which exports so much of our agricultural products, that's a critical thing that influences our markets. The other is, of course, weather. I don't need to say anything about the weather. This is a baseline, so we conveniently assume that the weather is going to be normal. But what we need to remember is that there will be volatility around what we show today as a result of these weather conditions. So that's always worth remembering. And I think in our own context, with the strong El Nino being projected for the coming season, it's always worth just remembering. And then, of course, there's a number of challenges that Ferdy already mentioned that influence our sector in particular. I'm thinking port and logistics, service delivery challenges, Eskom, the load shedding situation, and, of course, also the animal health biosecurity situation. So bear that in mind, everything up on the screen there, the big picture, as we go through the slides. I think Ferdy's already showed you the ag GDP. So I'll go straight to the bit more disaggregated view. What we've got on screen at the top there is the gross value of agricultural production. So this is just revenue, doesn't account for costs, but it breaks down for you which industries have been performing well and which ones have been struggling. And I think if we look back over the last 2-3 years, where agriculture was the star in the economy, it's field crops that was the star within agriculture, right? So this is where we benefited from good yields, strong prices coming from global levels. If you look at the other sectors, if you look at something like horticulture and animal products, which have grown strongly historically, they've actually been very flat in the last few years. So this is something worth considering. And also, if we look forward and the world that Julian described, where world prices start to come down, our field crops don't look so good anymore. And I think that's part of why we see the picture that Ferdy showed, which is incredibly flat, particularly in the short term. Of course, the green ones, the animal products, that's the one we probably will look to the most in order, to ignite growth. That's the biggest one. It's half of agriculture in South Africa. And then we also have growth. We have a lot of potential on the horticultural side as well. We have huge volumes coming into the market. If we can find a market for those volumes at sustainable prices, there's definitely significant opportunity that we can unlock there. So I won't stand still here. This is just a snapshot. It's basically what Julian's been talking about, but just have a look. This is the FAO food price index. Just have a look at how prices ran up. The reality is that for most of the last year, prices have been coming down since the second quarter of 2022. In South Africa, some of that was offset by exchange rate dynamics, but this is what's been happening in the world, and this is the reality that we face. Going forward, it's been mentioned already, there's a number of uncertainties that influences that path. One is the war, one is renewable energy, the animal health situation globally, the weather conditions globally. I like Julian's spinning wheel that he had there. It seems very apt for what we find. This trade policy environment, and again, the global economy. So these are all things just worth keeping in mind as we go through the outlook. Looking in locally, I thought I'd take a trip down memory lane as well, given that Fadi had such fun looking at the old outlooks. This is a graph that we used to show when I started getting involved in the baseline. It's the LSM, so it's the share of the South African population falling in low income, middle income, and affluent income groups. And as you see, we're declining basically from 2005 to 2014. Lower income groups getting smaller, middle income groups getting bigger, and your affluent group getting bigger as well. So this is a nice story, and this is what was also driving the outlook outperforming in many instances, the actual outperforming the outlook that we showed. If we fast forward to the current, we've got there real disposable income of households in the bottom left, nominal terms in real terms, and then the bars show the real change. Looking back over the last 10 years, 5 of those we were in the negative. So of course COVID was the one where we were in the big negative. If we look at 2022, we're still below 2019 levels. The implication of that is if we redraw the same picture and we have our low, middle, and affluent groups, we're now in a completely different situation. Your low income is still coming down, but your high income, your affluent group is also coming down, and we're falling back into the middle. So this has massive implications from a demand perspective, right? It also impacts quite differently on different products. So here we've got, thanks to our consumer team, a whole range of products costed in terms of a serving size unit, so not rand per kilogram, but rand per typical serving size. So you've got your basic staples at the bottom, your more affordable ones, and then it ramps up quite significantly to most of your meat products at the top there. Of course, those are the ones that are expensive and a bit more sensitive to changes in spending powers, whereas your basic food staples are maybe a bit less sensitive. But then we've also got to remember who spends their money on these products. So the chart that I've just brought in, that shows the share of total expenditure on each product per income group. So if you look at maize meal, for instance, at the top, that implies that 40% of expenditure on maize is by lower income groups, and 10% is by your affluent income groups. And then, of course, when you get to the lamb at the bottom, your most expensive meat, you're looking at 60% by your affluent population and only 5% by your lower income groups. So given that picture, the one we saw before of the movements between these income groups, I think that gives you good context in terms of where the sensitivities lie in terms of market going forward. Of course, income's not the only one. There's also population size. There's things like urbanization. So the chart that you see on the left, that shows the population density in South Africa, the nice map. It also shows the change in built-up areas over the last 6 years. And then on the right-hand side, you've got population growth. So population growth over the next decade, a little bit slower than what we've seen in the past decade, but it's essentially linear, right? So, of course, we're adding a whole lot of additional people and a lot of working age people coming in. So, of course, we need to make sure that there's opportunities for employment for these people, but this does in itself create some market for food products. So with that, I think we can have a bit more detailed look at some of the subsectors. We'll start with livestock, because it's my personal favorite, but also because it's the biggest. So let's just say it's because it's the biggest. A few key things to note. Firstly, producers have been under extreme cost pressure. I think that much is clear if you look at those price charts in the beginning. Those field crop prices that ran up so much was very nice for our field crop farmers, not so much for our livestock farmers that have to feed animals. But of course also other cost pressures, load shedding, the cost of services, etc. As I've just illustrated, your domestic consumers are under pressure. They likely will be under pressure for the next few years. That makes it all the more important to make sure that we have an export market for our surplus product, right, to ensure prices. This brings us to the animal health challenge, which we need to sort out in order to enable that. And it also implies that market access, maintenance of existing access and also expansion of market access will be critical. This illustrates that point. So it's showing basically the same thing, just for different products on the left and right. So we've got a basic profitability ratio, just output prices, so the various meats compared to maize, which is your biggest feed ingredient. And there you can see clearly, firstly, there's been a lot of volatility. This was the 2016 drought when all of them bottomed out initially. Then we had the big crop in 17, they improved. There's been a fairly consistent downhill slide since then. Some of them not quite to the 2016 levels, some of them below the 2016 levels. But I think it's clear that these industries have been under some pressure. It's also clear that as our crop prices come down, the situation does normalize over the outlook. So particularly in the second half of the outlook, we do still foresee some growth from our livestock sectors. This looks at the consumption side. If those of you that have attended most of the 20 baselines we've presented should know this chart by now. It normally looks the same. What does change every year is these percentages seem to get smaller every year, at least over the past decade. And that has as much to do with the macroeconomic situation as it has to do with us adjusting our projections. These industries, the reality is that they are strongly focused on the domestic market. Yes, there are some net exporters, there are some that are replacing imports, but the predominant biggest share of the product is going to our South African consumers, and so the economic situation here matters. Affordability also matters. The more strain our consumers are under, the more they look to affordability, and I think that's why you see, if you look at the pie chart we brought in here, it just shows the composition of the additional meat consumption projected for the coming decade. So, of course, poultry is by far the biggest one. It doesn't grow the fastest. That honor goes to pork, but poultry still accounts for about half of the additional meat that we'll consume. And, of course, this is the most affordable one as well, followed by our pork products. As I said earlier, given the situation domestically, it becomes all the more important to provide export markets for this product to move into, so that we can grow sustainably in this livestock sector. There are also success stories. I think we've said a lot about the difficult environment for our consumers, but let's just look at chicken quickly. So chicken, they signed the poultry master plan in 2019, if I'm not mistaken. This is imports. We went through a decade of rapid growth in chicken imports, 138% over the 10-year period. And since 2018, we've actually pulled back 35% of those imports. So I think that's a success story for the industry. There's been a number of factors that contributed. Avian influenza in the global situation, which stopped trade from many EU countries. There have been import tariff interventions, things like COVID, the cost of logistics, the weakening of the exchange rate. They all contributed. But I think we also have to give credit where it's due, and the competitiveness of the industry did improve over time. So this shows some work that we've done. We've done 3 cycles now. The first was 2015, then 17, and 2021, and it shows the relative cost of production in these countries, Netherlands, Germany, Poland, US, and Brazil, relative to South Africa. So basically, if it's above the line, it means it's more expensive to produce there, and if it's below the line, it means that it's cheaper to produce there. And I think if you just look at the ones, these leading exporters, look at the US, look at Brazil, in the 3 cycles that we've done, we've progressively got closer to these countries in terms of production cost. And I think the success of the soybean industry that Freddie's referred to has also contributed to that in terms of reducing the cost of feed for our domestic producers. How do we see the outlook then, given that? So here we're showing the classic outlook chart. We've got production at the back, and we've got net imports in the front, and then that profitability ratio from earlier. So I already indicated the decline that we saw. We do see some improvements going forward. Nevertheless, our growth rate over the outlook is a little bit slower than what we saw in the past decade. A lot of that has to do with the short term. So obviously we need to come out of this situation, the past few years of feed cost pressure in particular. Over the second half, that does start to look a little bit better. And I think, just to note in the short term that, the additional costs, things like the load shedding, etc., which is adding cost pressure to this industry. In the second half of the outlook, we do foresee growth improving. It's very much got to do with this profitability situation. Given where the local market finds itself, we also want to say that there was a second half of the master plan. Part of it had to do with sorting out imports. The other had to do with opening up export markets. And obviously, as we grow in production, that will become increasingly important going forward. So we have managed to stabilize imports reasonably. The share of imports in total consumption is also coming down over time, even though we get a small increase in absolute volumes. But we don't go back to the volumes that we've seen through that 2016, 18, 19 period. But we will have to start looking beyond our own market as well in future to sustain growth. The one that has done that successfully is beef. So a very similar chart than the previous one, just for a different industry. Again, showing production in the back. Of course, this has been more volatile, influenced also by the drought, slaughtering into our breeding herds through the 2016 drought in particular. Prices ran up, it was very profitable, and we've been pointing for some years to this herd expansion cycle of people rebuilding that breeding herd, which they reduced through the drought. I think that gathered some momentum in the last few years, particularly within mixed enterprises. So the ones that do field crops as well and had some good seasons in the field crop side. So we do see that coming into the market over the next few years. So there is additional supply on the way. And of course, again, we'll need to find market for that. Otherwise, there's going to be a significant price impact. Exports grew nicely initially, but that's very much stagnated, and there are reasons for that which we'll show shortly. But let's first have a look at that supply quickly. So if we just jump away from that chart, we're showing up on screen now weaner calf prices. And this is part of the reason why we say that supply is starting to come into the market. So at least if you look on the primary side, if you look at the reduction in weaner calf prices through the first half of the year, 17% for that 6-month period, that indicates that there is a supply of the primary product becoming available. We don't see that yet in slaughter numbers. So the chart on the right-hand side that shows slaughter numbers from as early as 2015-16. This, of course, was that drought period where we slaughtered into our breeding herd. But if we look at 2023 to date, we're still the lowest since that period. So we're not seeing it. And this has to do with the other side. So, of course, you've got a feedlot sitting in between. There's the supply of the calves becoming available, but the market is tight and the product's not moving. So then you get people not wanting to stock feedlots up to full potential. Of course, a lot of that has to do also with animal disease risks and so forth. The demand that we can create for this product, be it locally and or in export markets, will be critical to the level that prices find an equilibrium in the next few years. We've noted how critical exports are. Under the baseline, we go from 13% per annum in the last decade, granted most of it occurred in the early part of that decade, to only 3% per annum. Having said that, we also know that there is a comprehensive strategy that was developed flowing out of the AAMP that Fody mentioned earlier, and I think you'll refer to it again in the later presentation. But there is a strategy, and they are building towards increasing that. The target is actually to get from the 6% that this implies to a 25% of production exported. And if that can be achieved, obviously will require solutions also on the animal health side. But if that can be achieved, we're looking at an entirely different picture for the beef industry than what we would necessarily be showing under the baseline here. What we have seen in exports in the last few years is actually a decline, and I've mentioned the animal health situation. What the map shows is just the change in value over the past 5 years. So looking at 2022 relative to 2018, which was, of course, when we still had a foot and mouth free zone in South Africa. The blue is a decline, and the green is an increase. So here you can see absolute volumes were a little bit down, but also there's a significant shift in terms of where product is going. So, of course, the China market is impacted by the product not being allowed to go there. Some of it was picked up in the Middle East, some of it was picked up in North America. But the reality is also that the product mix is not always the same. So it's not always simple to move it just quickly into a new market. And I think if we can broaden the access to a number of alternative markets, we certainly will have a lot more options. As I said, the biggest reduction in China, some going to the Middle East. But also our neighboring countries impacted. So, looking at Angola, Namibia in particular, there was some constraints in there. And then also to say that foot and mouth, we often talk about foot and mouth because of its trade implications, but it's definitely not the only one that's causing challenges on the animal health side, right? We see that across a number of industries and for a number of diseases as well. That's what we try to show here. This is quite a striking picture to me. So it's a bit of a long-term view over time, putting foot and mouth, avian influenza and African swine fever on the same chart. Where the dot is situated gives you an idea of the number of outbreaks, and then the size of the dot is the number of animals affected. But in this case, not just animals, we did animals multiplied by carcass weight, so to give you an idea of sort of the number of product typically affected. But I think it's clear if you look at this cluster on the right here, how the situation has deteriorated in the past 3 years relative to most of the past decade. The last one then to show is pork, and that's of course one that's also influenced particularly our cross-border trade, although exports is a smaller share of this industry. I think the pork sector is a bit different to many of the other livestock ones in that whereas as beef and poultry at least had some price support in these last 2 years when feed prices ran up, pork prices didn't actually run up. They actually came under pressure because we had quite a bit of additional supply coming into the market. So this profitability ratio here went to a level that it's never been at before. That's the lowest that it's actually been. So I think there's been a lot of strain in that. We have seen some improvements on the price side, also in light of international dynamics with EU prices increasing in particular, and feed prices also coming down. But we do still foresee some cutback in the short term before growth resumes in the medium term. And then, over the outlook period, we're looking at about 2% compared to 5% per annum growth over the past decade. So that is significantly slower. And of course, productivity will be critical to achieving that sustainably. Given that pork prices declined while most other meat prices increased, that shift in relative affordability also implies that we did see a significant increase in the consumption of pork products, which I think for the industry is also positive. So that's it on the livestock side. Let's have a quick look at field crops here. I think, in some sense, some of these issues repeat themselves over the various subsectors, but then in some sense they're also different. So now we're a net exporter of most of our major field crops, the big exception being wheat, of course. But for most products, we're trading at or near export parity prices, which implies that the declining world prices will spill over quite directly into our markets. What we will say is it's been a very good past 3 years, and I'll show a chart later, but we have actually seen that many of the profits generated over the last 3 years have been invested back into these businesses. So that puts you in a good position to deal with the next down cycle in terms of efficiency and productivity. What we do need, though, is that new products which are available and are in the pipeline get registered efficiently and quickly, so that they become available to our producers to use as soon as possible. And what we also need is something that we normally measure in the horticultural context, is a look at the efficiency and the capacity of our major ports. So this is South African prices. I've mentioned already the extent to which they increase, but I think the picture is quite striking when you look at it there, as is the picture of them coming down in the next few years. They don't come down to the same extent as international prices, given that our exchange rate has weakened. And also over the outlook, there is a little bit of an offsetting there, but over the outlook, we're looking at on average about 2% per annum decline in the exchange rate. So it's not as big as what we've seen in the last few years. Again, there will be volatility around this. This sector is the most sensitive on the climate side, so there will be volatility around this depending on rainfall conditions. But the reality is that these are nominal prices, which are essentially flat over a 10-year period. So if you adjust that for inflation, we're looking at real prices coming down. Of course, that implies we need to get more productive if we're going to stay profitable. This is just the input side. We've talked a lot about prices going up, but it was not just output prices, it's also input prices. So this shows from 21 to 22, 36% herbicides, almost 50% increase in diesel, more than 60% increase in fertilizer. So it's not just prices that ran up, the input cost environment also did change. The good news is that we have seen those come down as well. So if we look at the first 6 months of the year, so the year to date, and compared to a relevant period in the previous year, we've seen a decline. Those are the green bars. And if we look at the projected annual average for 2023, there was also an expectation of input costs coming down. The net effect of that, Firstly, you can see the good yields and the high prices trump the input cost increases in the last few years. These are margins, they're gross margins for dryland and irrigation, a combination index for summer crops. But they do come down in 2023, and that's prices coming down, and it's also yields normalizing. So normally in the baseline, we would work with an average sort of a trend yield, so accounting for technology, but not an above or a below average year in terms of weather. Again, this will likely go up and down around this trend, depending on what weather conditions do. I said earlier that producers have reinvested. This shows two indicators. Firstly, the blue one is agricultural debt. So I think it's quite striking how that has run up over the past 3 years. What's nice is to see the complete change in that trend in the last few years. So that says that at least some of that money was, of course, the debt is for all sectors, not just for field crops, but at least some of that money went into changing that situation. But look at the machinery, tractors, machinery, and implements. So we had quite a prolonged period since 13, 14, through that drought period where this was really flat. And then look at the last 3 years, how that just increased. So a lot of investment, replacing products, replacing your technology, it's obviously gains to be had from that in terms of efficiency going forward. Area-wise, this is quite an aggregate picture. So on the left, we've got total summer crop area in blue, total winter crop area in green. Winter crop sits on top here. It's actually on the right axis, so it's obviously a lot smaller than your summer crop area. But this peaked in 2022, and for the 2022-3 season, the one that will be harvested this year, or is being harvested this year, we already saw a little bit of a cutback. With prices trending down and sitting basically at export parity, we do see that consolidating again. We've been well above the norms that we saw for most of the past decade. So we are looking still at reasonably strong area, but some reduction from the current level. So there's always this 200,000 hectares that's not necessarily sustainable at I'll call it a normal export parity level, for lack of a better word, but when world prices are more normal at that export parity. What's clear is that we've had a big shift from grains into oilseeds. So this is just the composition showing the share of that total area in grains and in oilseeds. Increasing shift. This goes a little bit slower over the outlook, but maintains that trend. And I think that's a result of this consolidation that we see here happens mainly on the grain side and not so much on the oilseed side. So oilseed, we see growth slowing, but being maintained, whereas on the grain side, we actually see area contracting. And here you can see that for the individual products. So by 2032, compared to an average for the last 3 years, we've got maize area coming down 16%. Wheat and sorghum also coming down a little bit, though not so much. Barley is a little bit up. I must say that 2020 to 22 was well below average for barley. So if you look at the 2032 and you compare that to sort of the past decade, it's not actually a very strong area. It's actually a little bit down. But then look at the oilseeds. 37% still for soybeans, more than 50% still for canola, and sunflower contracting a little bit. Of course, the ones where the area's coming down, we've got nice, strong yield growth. It doesn't maybe look as impressive as some of the numbers that Ferdy mentioned earlier. It also has to do with the base period. So we have to recognize that 2020, 21, 22 were all above average years, and this is growth coming from that base. So it's very much on trend with the growth that we saw in the past. And then the oilseeds again buck that trend. So we've got for sunflower, we've got declining area. We're losing some of the marginal area, the area that struggles with things like sclerotinia, etc. And there we see a yield response. But in soybeans, we've got strong yield growth together with area, and we also see that for canola. So this is very much technology. So our technology team tells me there's a lot of new products in the pipeline that are already in the process of being registered and will become available to our producers. So we already, for things like canola and soybeans, we've already seen a step change in yields as some of that technology was released, and with more of it coming, we are quite positive with the yield prospects going forward. Ferdy, I think we can be, given that you showed that we tend to undershoot, so let's be positive with it. This is use, again, field crops. So again, we've got the grains on the left-hand side, maize being the big one, and wheat. So two things we show here. Firstly, the change again by 2032 relative to the current, to the base period. We also show the net trade position. So here you can see maize a strong net exporter, soybeans also a strong net exporter. Of course, wheat, we are a net importer and we likely will remain, and this is just to do with our natural resource potential and the area that's good for producing wheat. Demand growth, if you look at maize, we're looking at 6% in total food use and 17% feed use. This is sort of the aggregate picture by 2032. In the short term, we actually see food use being a little bit stronger and then flattening off, in relation to our consumer environment, whereas feed is the other way around. So that's a bit flat in the short term when our livestock industries are not growing that strongly, and then accelerates in the latter half when those industries' growth becomes stronger. As I said, net exporting now, of course, this is good for the competitiveness of our livestock industries, which we feed those products to. And as Fadi indicated, with ongoing replacement of imports of things like protein meal and also vegetable oil, it obviously leaves scope to crush quite significant volumes of these products going forward. So let's look at soybeans just. I won't go through all the individual products, but we like to show soybeans because it's been such a success story. Look at the rapid growth. Again, we've talked about it a lot, but look at this net trade picture. So significant surplus is being generated. And I think, for a long time we've been saying we've got surplus crush capacity, we need to expand soybean area so that we've got enough beans to utilize that crush capacity. If you look on the right now, with that capacity relative to use, we're actually getting in a situation where we'll have to expand that capacity again quite soon. So I think there is probably opportunity to do that in the next few years. If you look at where the area has been expanding, a lot of the recent growth has come from the western parts of the country, which wasn't necessarily the case historically, which would suggest that maybe there's also opportunity then to expand the processing facilities in that part. Of course, soybeans not the only thing we're going to be exporting. This is presenting a bit of an aggregate picture of our major field crop exports. So it looks at white and yellow maize, soybeans, and also sugar. These are the four biggest ones. Look at this increase in the last few years, almost 50% from 2020 to 2023. The reality is that we are struggling a bit to move those volumes. So if you just look at prices, our maize prices traded well below export parity for most of 2023. I think that's an indication that those volumes aren't moving that efficiently through the ports. The baseline, with the cutback in area and the return to trend yields, we do see these volumes coming down a little bit, particularly for maize. The soybean volumes, of course, are strong, as you just saw. The reality is that this is normal weather. And as I said earlier, there will be some volatility around that. So what we've done is just looked at historic yield volatility and what that implied for trade. And if you put that around this average here, this is the upper bound. So if you look at where the good years are likely to be, that's above the numbers that we've seen recently. So that suggests that we really do need to look at this capacity as well in terms of expanding it. Given where these products are produced, they'll likely need to go through Durban. So this is normally the focus. I think if you look at the fruit sector and the recent investment into the container terminal to try and get improvements there, it shows, of course, that there is an urgency and a recognition that this needs to be done. So I think that's positive for the sector as a whole. The one that's less of a success story than soybeans is sugar. So this is our sugarcane area, and you can see that's been contracting fairly consistently for most of the past decade. We also expect that contraction to continue over the next few years. So it does slow a little bit, but still going downhill. That is offset by yield gains and efficiency gains. So if you look at the sugar production up at the top here, it's a different story to the decline that we see in area. Of course, we don't want to see area decline because this is an industry that's quite labor intensive and supports also a whole lot of small scale producers. So we don't want to lose this area. But we do have fairly flat production. We also have fairly flat consumption just by nature of the product. So of course, the demand for sugar is not growing rapidly, and we also have seen a number of policy actions designed to curb that demand. So one of them is the health promotions levy, which was implemented a few years ago. They are looking at increasing that level maybe in the next few years. It wasn't done because of current distress in recent years, but that is a possibility. And then there's also things like front of pack labeling, etc. Some scenario work that we did here, we've got national cane area If we reduce local demand by 160,000 tonnes, which is not just a number that our sugar team came up with, it's based on some surveys with the major companies and what the health promotions levy would imply for formulation, that's quite a significant reduction in total area that could come if that is increased and implemented. On the right-hand side, you see the impact of that spatially. So that shows a composite risk index. It's looking at a number of factors, including which areas are good for production, which are more marginal, and shows where this area is likely to be lost. So of course the North Coast is the one that's at highest risk. And this is also where we find a lot of our smaller producers. So this then becomes a question, are we going to lose many small-scale producers, or are we going to need to spend more money to support them in order to keep them in business? So last one, horticulture side. I think we've touched on some of the issues that speak to horticulture already. This is an industry that's invested massive amounts over the past decades. You saw the figure by Fadi. We've already hit the 2030 target for the NDP. Of course, that product coming into the market is also weighing on prices. So we need to make sure that those investments that we've made are sustainable so they can contribute to jobs, to foreign exchange, and all these areas that the sector contributes in. It's also, given the role of exports, infrastructure is critical to move that product. A lot of that product needs to move through our ports. It will require efforts across the value chain, not just on the producer side. So I think our producers have proven themselves resilient. A number of actions have occurred on farm, but we really need to look at the rest of the chain and make sure that that's operating efficiently to ensure sustainability. This shows those price movements. It's quite busy up top there, but we've got many industries to look at, as our horticultural team often reminds me. We've got export prices on the left, and we've got local market prices on the right. If I just put the dotted line in there, that's typical average inflation. So there you can see the green lines. That's the movement, the average annual movement through the last few years, so from 2019 through to 2022. And then the blue ones is the projection for the outlook. So you can see, especially on the export side, many of them, some negative, many of them well below inflation, and generally a little bit better over the outlook, mostly over the latter half of the outlook rather than the first half. But this is, of course, it combines a number of factors. So it's additional product coming into the market, it's products struggling to move through the ports, etc., that all influences that. The implication of it in terms of profitability, we just show here for potatoes, which is, of course, quite an input-intensive industry. We've simplified it significantly, so this is just the potato price compared to fertilizer prices. That's not saying fertilizer is the only input used on the potato side, but it is, of course, a major one. So it just gives us some idea. And here you can see the fact that prices didn't increase through that period where input prices increased sharply, the effect that has on profitability. So we are seeing some normalization now with less supply in the market. And if we look longer term, if we can just summarize the potato market outlook in one chart here, very flat area, so less than 0.5% per annum growth in area over the 10-year period. Most of the production growth, so we're looking at 1.5% per year in terms of production, most of that coming from yield gains over that decade, and of course most of it being consumed in South Africa, given the nature of that product. Our fruits then are much more export orientated. So here again we've got nice aggregate view. Look at this area expansion over the past decade, so that's huge growth, and then look at the outlook, so just 3% over that 10-year period, so very flat in terms of area, some contraction in the short term and then stabilization, but the volumes still increase all the way. So that's firstly that's your normal yield gains in terms of efficiency, in terms of technology, but it also has to do just with the age of your orchards, right? So here we've plotted the main products, looking just at full bearing equivalent area and area that's not yet bearing. So look at these big ones here: soft citrus, lemons, soft citrus more than 40% not yet bearing, lemons 30%, 50% of avocados not yet bearing, 63% of macadamias not yet bearing. So this is trees that are in the ground, but they're not yet actively contributing to production. So this suggests that there's the volume picture that you saw in the previous one. That's where these volumes are coming from. So there's significant volume coming into the market. And again, I've said it before, we need to find a market so that we can ensure that it moves at sustainable prices. The map, if it looks complicated, it is because it is complicated. This is what happens when our horticulture team tells our data science team, I've had an idea, and they say challenge accepted. So we've got basically the whole value chain on the map here. The pie charts show production, so that's the major products being produced in the various regions. So of course you can see the Western Cape, which is big on fruit. Then we've got the orange in the back is population density, so that's where our local markets are. We've got our local fresh produce markets also operating on here. The trucks are sitting at border posts there, so land border posts, and then the ships, obviously in our major ports where these products need to move through. The long and the short, if you look at this picture, the table on the right-hand side there, we have seen massive growth in exports, and we're still looking at about 26% over the coming decade. This value also seems to get smaller every year. That's not because there's less, it's just because the stuff is actually starting to come in, so the base increases. But that's still significant growth in volumes. We're already struggling to move volumes, so that's significant growth coming. I think maybe just to point out on a positive note, the investment that we've seen from private equity into Durban's container terminal. I think there's quite a lot of hope in the industry that this will have an influence on the efficiency of that port in particular, replacing some older machinery and getting the product to move through there a bit more efficiently. I've said that we're already struggling. This is the units moving through our ports in 2018-19, so it's sort of pre-COVID, pre the war, pre all the challenges that we've seen in the last few years. It really just gives us a bit of a benchmark. Then we had COVID, particularly this early period when we had the hard lockdown. You can see the impact that had on volumes. Then we had a period of reasonable recovery where we actually improved quite a bit. So this is the average for 21-22. There was still issues. If you look at this one here, that was in October 22, we had the Transnet strike, which pulls this one down quite significantly. But then we've also got weather conditions that often influences our ports, particularly in the Western Cape, and also the management issues around that, which also makes a difference. If we look at 2023, relative to all these other lines that we've got in the back there, firstly, striking that it's a lot more volatile, so a lot more up and down over time. But also total volume for the year to date is well below what we saw in 21-22. So apart from the COVID year, very low compared to the previous, the last few years. So that's obviously not a good picture to see if you're an exporter needing to move product through these ports. This is the World Bank index that looks at the efficiency of our ports. I think we've noted before that we come down in quite low there. We're hoping that will improve as we get investment into these ports. But of course, it's your most perishable products that are most sensitive, right? So when there's delays in ports, these are the ones that feel the brunt of it. So just looking at blueberries and stone fruit here, significant growth expected over the coming decade. A lot of that growth needing to go into export markets. So obviously for these industries, it's really critical to get these ports moving. It speaks to the quality of the product. If it's stuck there, you lose quality. It's entering the market at the wrong time. We have markets that are short and then flooded, and it's all sort of into a negative spiral as it influences the profitability of our producers. This is the same as what we had for the other ones, except for the million products on the x-axis here, again showing growth. So looking at 2032 relative to an average for the last 3 years, you can see again this growth in production. It also splits it by marketing channel. So there you can see that the bulk of this additional product will go into the export market, which of course means again that it needs to move through our ports. So I can't overemphasize this enough, that needs to work efficiently for this to be sustainable. But it also implies that markets are critical. So we haven't forgotten about markets. And I think that has two aspects. The one is retaining the markets we have. Looking at something like AGOA, we have huge volumes of product going to the US currently, so that's around 9 billion going to the US, mainly macadamia nuts, oranges, wine, mandarins. So that's obviously, that's one aspect of it, but we need to look at the competitiveness of our current markets, and then of course also expanding market access so that we don't flood the current markets that we have with the new volumes coming into production. This just considers the contribution of these industries. So we've got two, we've got citrus and we've got wine, both of which are fairly stable in terms of area over the coming decades, so little change in area, but not little change in contribution. So if we just look at the value of production, look at the value of exports with these additional volumes coming, so almost 70% additional exports. In citrus, it's the case of volumes. In wine, it's the case of price, so it's looking to add more value, moving to lower volumes, moving to higher priced products. Local sales also increasing 90%, 120%. This is again depicted in terms of value, not in terms of volume. So for something like wine, for instance, that's a fairly constant volume, but it's moving at a higher value thanks to a real increase in prices. If you look at jobs and dependents, that's not shooting out the lights in terms of increases, but we're looking at 750,000 people in citrus and 1.3 million in wine that's being sustained in these industries. So I think that in itself is an achievement already. Citrus we've showed for some years. It's also the biggest one, so it tends to be the example that we use. It's not the only one that's struggling, but it is certainly, if you look at the baseline, prices have been coming down for quite a few years now. We see prices maybe bottoming out in the next year or two, but this is just the risk profile. So this is our farm level team doing some risk analyses, so multiple runs, changing key variables and looking where that comes out. The red is a negative earnings before interest and tax. The orange is a positive one, but not sufficiently positive to cover things like debt and interest. So yellow and green, this is really where we need to be. And there you can see, particularly in the next few years, those risks are still quite high. So we looked at options to mitigate that, very much focused on farm. So this is looking at the role of exports, so increasing the share of exports in your total market, moving to a higher quality product, so getting more exports into this class 1 category, and also looking at the size and the counts and getting that right and matching that up with what your markets really need. If we can get that right, it needs additional costs at producer level, so there's obviously production practices that need to be done to achieve that, and that implies that there will be an additional cost. It also implies that we can unlock more value, so we can change that picture quite significantly. If you look at the red and orange on the right here compared to the baseline one, if we can get a few things right, there is a difference to be made, and that's around a 40,000 rand per hectare improvement in 2024, if we can manage that. Of course, there's also other things that influence the sector. This again looks at on-farm, so it's showing the same measure, but this is for a palm fruit farm in the Western Cape. The baseline, as you see, it doesn't start from a particularly favorable position, obviously because the sector is facing a number of challenges. There's been adverse weather, drought, hail, things like that. Of course, the infrastructural issues that we've mentioned, and then also things like load shedding, the ability to irrigate, and so forth. These are actions that need to be taken post-farm gate, right? So things to solve things like load shedding, that's not necessarily, you can invest in alternative systems, but the producer can't solve that himself. But it influences them. So look at this picture in under the baseline, which is, if I need to relate it to load shedding in particular, it's sort of the situation that we're in currently. So maybe level 2, level 3. The scenario here is one of consistent level 5, level 6 load shedding in the short term. So you can see the impact that makes. In the longer term, yes, per hectare, we do get back to reasonably the same level. So this assumes that we solve this problem over the next 3 years based on the current investment that we're getting into the energy sector. But there will be much fewer hectares. That's part of why we see this normalization. And that's also a response given the shortages, the ability to irrigate and things like that with load shedding that's reducing the total area. So on a per hectare basis, we do get back to a similar number, but in total, the value being generated by this industry is significantly smaller. That's it. I think we did just go a little bit over, but we made the bulk of it in time. So thank you very much.